I know that people are joining. Hopefully, I think that more will join. But in the meantime, we could potentially start, right? Okay, so let me just welcome everybody and thank them for taking the time out on this Saturday morning to listen to this very interesting topic on valuation of intangibles. And thank Anand also for doing this. This I've noticed of late is of great interest because we are getting a few assignments which deal with brand valuations, and it will be very nice to hear from a person who has the experience in doing this to speaking to us on this topic. With a short introduction on the topic, I'll just hand off to Shilpa.
Good morning, everyone. It's a pleasure to introduce today's speaker, Mr. Anand Gawade. He's a qualified chartered accountant as well as a registered valuer. He has extensive experience in practice for more than 20 years and actively working with clients for valuations. He's also a trainer and speaker on various platforms on valuations. Over to you, Mr. Anand.
Thank you, Shilpa. So basically, as a practicing registered valuers or maybe even as a chartered accountants or cost accountants, we get a lot of actually inquiries for business valuation, shares valuation, etc. But 1 out of every 10 inquiry, if you are really actively practicing in valuation areas, you will always get 1 out of 10 inquiries for intangible assets valuation. No, valuers are, I'm not sure why they are skeptical to not to study all these areas which are actually very easy to understand and follow. You just need just to fine tuning of your existing certain assumptions into valuation modalities and learn little bit of technicalities of that intangible asset. Typically, everyone will get for the brand valuations. This is very common requirement. But people don't want to pay for brand valuation. That is my experience. They say, I am very, my brand is very established and all. Then you have to tell them every intangible asset also has a monetary value. You have to pay to the intangible knowledge base of valuer. So, but this is very lucrative area actually and highly paid. Of course, number of assignments are limited. Now, not every intangible asset, we as a finance or legal experts can do that valuation, like especially formulations, or if you have to do certain technical patent valuations, you need to join hands with certain engineers or maybe some experts into that area to understand that industry, that product, what is going on that, because finally in any valuation, cash is king. Either any asset, maybe tangible, intangible, business, whatever. If you're valuing, you have to look at the cash generation capacity of that particular asset. That cash generation may be directly generating cash or cost saving, either or. So somewhere cash is unavoidable. Only because I'm having some brand, XYZ brand, and that is just with me and I'm not using it, it has zero value. There are so many experiences with me, like someone is doing business and just got some brand registered and now he want to value that. I said, what is the value of this brand? It's only 15,000 if you have paid for trademark registration. Brand valuations or any IP valuation will always come up only when it has tangible cash generation or cost saving capacity. That is a thumb rule. Now that will be direct or indirect, like it will add cash to you or it will save cost directly to you, or you can, like, you are paying some non-compete fees for your competitors, it will indirectly saving your cost and like that. So whenever you are following this practice, you have to be first, you have to have very strong common sense, basic technical expertise, very basic. You need not be expert into softwares or you need not be expert into some automobile or something like that. No need. You can hire some, get associated with some expert into that area, and you can very well practice this area. This is very lucrative area. I'll just begin. Typically, IVS 210 covers this entire area. This is just the some part I have used from the IVS only. So what is intangible asset? Is a non-monetary asset. Non-monetary asset which will give some rights, okay, and it will grant rights for economic benefit to the owner. So economic benefits, again, very technical term. Economic need not be cash benefit. Direct, indirect. Economic word is very vast word. It includes cash. Economy, like, I mean, very difficult to define, but I mean, now non-monetary asset is asset whose value will change over time in response to the economic conditions. Monetary asset, like suppose cash or gold value, it will not vary in that direction so fast if there is economic condition changes, but non-monetary assets will change immediately. For example, if there is a so let us say pre-COVID period, somebody had actually predicted about COVID and had this formulation. What was the value? There was no value because nobody knew this COVID thing coming up in 2019. But suddenly in 2020, everybody was, awake, and so you will see the rise of this Zoom, rise of these Teams calls, rise of these all formulations and patterns and everything started. So any nominal economic condition change, it will have economical impact on that non-monetary asset. So, and there is no relationship of say 1% change in the economy, it will have some percentage of change in the product. There is also no such relationship. It will have multiple level effects also. No fixed rate changes or something like that. Typical examples of intangible assets broadly, like marketing related, customers, artistics, contract, and technology. These are typically broad categorizations. Marketing, as I said, like trademarks, brands, designs, domain names, etc. Then customers like contracts, relationships, artistics like books, films, musics, your rights, radio rights. Contract, again, non-compete contracts, permits, broadcast rights. Technology, again, like patents, processes, software, everything. Technology is a very vast word. These are typically 5 broad categories where you will have every IP. You can classify that. Now there are certain overlappings also, like employment contracts, whether it is contract related or how. Non-compete contract is whether it is contract related or customer related. That depends on where you are, why you are doing that kind of registration, acquisitions, or why you are paying that kind of fee. You need to go into the purpose of this entire valuation. So again, going back to the basics of the valuation, you will have to go into like purpose, objects of the valuation, very well defined. Unless you have that well defined corners, you cannot do this valuation properly. I'll just take this theory for like 30 minutes because unless you are very clear on this typical like terminologies or concepts, it is very difficult for you to understand how it will be calculated and why some of the stands you need to take in different ways. Like these are types of intangible assets. Like again, no two intangible assets are similar. Okay, they're like identical. They are similar. Like you can compare Zoom and Microsoft Teams, but you cannot say they are identical. There is always some differentiating factor, and that is the reason. If you look at the approaches for intangible asset, you will see the cost method they have given us, and they have typically told us that do not use reproduction method. Normally avoid for intangible assets valuation. That is the reason, because you cannot reproduce any other intangible asset just keeping it ahead. It will always have some differentiating factors. So what you can do, you cannot reproduce. So only other remaining method is, and there are only one method they have given in the recommended in the cost method that I will cover going forward. Again, other like brands, if you compare Apple and Google, both are technology companies. But again, there are established brands. But again, the basis of this, though both the brands underlying with the brands are totally different. So although brands are equally, if you compare like Microsoft also with Google or Apple or like that, completely in-housely different. No, fundamentals are totally different. So you have to, go into depth while you are, suppose you are given an assignment to value Google brand. You can you just copy that Google brand and do some Google search actually and do the valuation. It is not that easy. You will have to go into different verticals, understand their financials, their annual reports, read those, what are they into, what is their future plans, and everything you will have to consider. And then only you can do that kind of valuations. Again, purpose, very basics of every valuation assignment is purpose. What needs to be valued and purpose of the valuation. People will always try, and especially the employer will always try to emphasize that he has got multiple intangible assets. Like I have my so many staff, I have my technology, I have my this process, etc., etc. But nothing is documented. There may be like any other manufacturing process, there are certain manufacturing processes, quality controls, etc., etc. But whether it has a right to be get valued, whether it is transferable. Suppose I have given some valuation to any process, but question is also remain there whether it is transferable to somebody else, or it's a unique something or not. That also, those logics also you need to apply there. So when you are doing IP valuations for any particular like special engineering field, you need to apply lots of common sense also. Just don't do Excel sheet calculations, and no, that is not wrong, but that is not perfect also in my opinion. You have to apply lots of common sense in IP valuations. Unlike like shares valuation, we know where we have to reach typically, or there are very limited assignments where you are actually hired to give realistic valuation, then management will take the call. There are limited assignments like that. But typically when we do for compliances, we know the answer where we have to go. But in IP, there is no such answer. Now you have to set your own questions and you have to write your own examination. So only thing is that you have only syllabus with you. That is the difference between normal equity valuation and the IP valuations. These are typical steps in valuation of intangible assets. One, scope, purpose, very basics. Every standard with every other valuation assignment, no, nothing different. Like your scope, purpose, identify those IPs, understand those IPs first. Like only brand, what is brand? Brand will not come only as like a piece of paper. We have certain misconceptions, and brand means only if it is a registered trademark. No, sir. There are brands which are unregistered, if I'm not wrong. Still, you can value those brands. Maybe you can discount, but there is a value to the any unregistered brands or trademarks also. Like then understanding these all IPs, do your own analysis, studies, do your due diligence as per your standard requirement or your assignment requirement, and do some calculation drafts. Now calculation drafts, I will give you why this is important. I will show you how much variance you will get in numbers using same set of numbers, same assumptions, but two different methods. I will explain you in our practical studies. Now, when you do due diligence, you will arrive at some calculation draft, first draft, which you can, don't share this draft to the client because this is not foolproof. Now, most important step in my opinion, you have to now apply your common sense. Whether this draft is correct or not, or whether it is apply that you are like an investor or you are going to be one of the buyer for this brand or this intangible asset, and see whether you will give so much of value for this or whether there is a logic for this or not. If you find any deviation, or if you find yeah. So you will have to apply your common sense. Again, reworking is always advisable, and then there is a final value report. where you can discuss with the management and conclude that. These are typical steps in every valuation, not only intangible asset valuation. Typically, market approach, three approaches like market, cost, and income. More emphasis is on the income side in the actual realistic life practice, because very rarely IPs are bought or sold. Very rarely. It's not that they are not bought or sold in the open market, but very rarely. So public domain comparables are very limited. Like I have given one example in India only, like Indus Tower acquisition by Bharti Infratel. So what was the logic behind this? I have given the link. I'll share this PPT with you. So logic behind this is they have got some 71,000 crore enterprise valuation for 1,63 towers. So what is the logic here? The logic is per tower value of the business. So this is the way you can identify per tower valuation. Now there is a bulk patent deal, like Kodak got bankruptcy some years back. So they had some, I think, 1,000 or 2,000 bulk patents with them, which they could not encash. So Google or so many technology companies acquired those patents. So on an average, so there was one report I got to read, and on an average they paid around $500,000 for every patent price. So you can take this kind of benchmarking also. Like somebody want to evaluate some technology patent into some this some industry where Kodak used to deal in. Now you can use this kind of references also. Now in Kodak, what is the issue? It is underpriced probably, because Kodak could not on their own use their patents, because there is no cash generation capacity. So Kodak got bankrupt. Now that is the reason they got all this low valuation. Does not mean you have to use this valuation only. This is one of the just comparable. Again, in entertainment business, you will see this Sony business acquisitions and all that part. So you can see how many films they got during this acquisition, because every film has its own credentials. Every film has its own valuation. So nobody will value every film. So on an average, like they will get 2,000 rights, 3,000 rights, 10,000 rights. So accordingly, you can just see this link. You will see that some history on that acquisition. This is how the market approach will work in the IP industry. Cost, as I said, reproduction method is not advisable, because you cannot reproduce identical intangible asset. So only other method recommended in is replacement cost. Typically, replacement cost, we can have cost approach where other two methods are not practical. But what are those kind of other two assets where cost approach can be applied? They have given certain, like very typical examples of acquired third-party software, internally developed software, or non-marketable software. Suppose I have developed some internally accounting or some HR related softwares, then I cannot do the valuation because it is customized as per my need. The only other option for me is cost approach. Now, how cost you will calculate cost approach is do like identical historical cost, add some inflation trends, or maybe current staff cost over that, identify some indirect overheads, direct overheads, all that part, and add some profit margin also. Why profit margin? Normally we don't add in other cost approaches and other valuation methodologies. Here we have to add the profit margin also. That I will explain you on the next slide. Most important factor is tab. Now, what is tab? Tab is basically like in India, if I have some, I bought some patent, for example, or some trademark, then I'm allowed to apply depreciation on that. So the logic behind tab benefit is that if somebody, I'm going to sell my intellectual property to any other guy, he is going to use the tax benefit out of that. So you have to identify the tax benefit over a period of time and do the tab calculation and add value to the tab. Now, where tab is to be applied and where tab is not to be applied. So standard is very clear on this part. Standard says wherever there is the income approach, it needs to be explicitly calculated and included. So calculation and included is almost compulsory if appropriate. Why appropriate word? Suppose some companies want to carry out some valuation of say brand for internal recognition purpose or accounting purpose, then don't apply tab. But if you want to license this out, or if you want to sell it out to third party, then you have to apply the tab also. But tab is not to be applied on other two methods, like cost and market. Market very obvious, because if somebody actually there is a market deal, they already have considered tab impact on that valuations. So you don't double calculate that tab impact on that valuation using that market approach. That is the logic. And cost, again, cost is mostly where other two methods are not applicable, or it is internally generated asset. So that is why you have already taken those benefits. So again, that is the reason tab will not be applied. Again, there is some slight dispute on cost approach, because suppose I want to transfer certain internally generated asset to somebody else, then there can be a tab application in my personal opinion. However, the standard doesn't permit that. The standard has explicitly said that only income approach you have to calculate and include it if it is appropriate. Standard.
Mr. Anand,
Yes.
just 1 minute.
Yes.
I understand there was some income tax amendment with respect to the same thing. Just in case you're aware, you can just throw light on that. Very recently,
I
someone.
think, yeah, so I think you are talking about the self-generated intangible assets. So I think if you are buying these assets, you are allowed to, I mean, if you are really paying for these assets, you are allowed to do the depreciation. This is what I understand. And if it is self-generated generated assets, then you are not allowed to do that. This is, I think, amendment or issued some notification into this regard. There are certain case laws also.
Mr.
Yeah.
Anand and Shilpa, just to add on to that, I think the amendment, if my understanding is correct, I can also read up and clarify in a while. The amendment is that goodwill, acquired goodwill was always eligible for depreciation. But there has been an amendment which says that even in case of acquired goodwill, there is no depreciation benefits that will be allowed. So that means to say that starting from financial year 21-22, you are not allowed to calculate depreciation and take that benefit, is what is my understanding. So that effectively means that you can definitely, for book purposes, for Companies Act purposes, maybe you can claim the depreciation benefit, but not for income tax purposes. So effectively, it means that for income tax purposes, it just remains as a cost. But as and when you sell that asset, you sell that goodwill, you can actually claim the benefit of the cost of indexation, treat that as an capital gain and claim the benefit of cost of indexation. This is my understanding. Anybody else can also add to this if they have experience or inputs in this regard.
No, you are right, actually.
Thanks, Kusum. I was aware that there is an amendment, but I was not clear as to what was that amendment.
Yeah. Now tab calculation is some Excel sheet calculation. Actually, it's not only reverse calculation, but there is one website which will give you a ready-made calculation. You have to just key in your assumptions. You want to calculate tax impact on quarterly basis or yearly basis, how many years depreciation is allowed, or etc. etc. You will see this link here. I will share you this presentation, and you can use this link to calculate all these tab calculations. Cost approach, as I just told you, replacement cost method. These are the typical steps. One is direct and indirect costs. You have to add like labor, material, etc. Okay, then apply this depreciation or balance life. You have to add that thing. Then profit marker is you have to add the logic behind this profit marker. This is not there in the other cost approaches in like any other method given in other standards, but here they are specifically told to add profit markup, because if you are to value any asset, you will have to consider that this is being sold to you by somebody else. Then he will always have some profit over that. You are not just creating any new asset, but you have to add some profit also on the cost. So you will have a fair value of that particular asset, like on a arm's length basis. That is the logic. Only this is the difference if you understand this basis. Now there are again normal IVS 104 basis and other things, valuation approach methods, etc., etc. So it is very much clarified in the standard itself how to be done or not to be done, etc. Now opportunity cost also you will have to add. Opportunity cost in the sense, suppose I have some ERP software which is internally customized. Now I want to value that. So whenever I'm doing this analysis of adding cost, direct cost, profit markup, etc., etc., there is always some losses which I will lose. I mean, profit I will lose, or some additional cost I will incur because I don't have that typical asset with me. So those things also we have to calculate and add to the replacement cost. This is how IP will be calculated. But normally this is not considered when you are doing other cost methods into other for other assets, opportunity cost methods. So now why opportunity costs? Because this is IP which will give you immediate cost saving or cash income. So you will have to factor that savings of by using this asset, you will have to factor those costs also and add those costs. These 2 points are very important from cost approach methodology. And believe me, cost approach is typically used in the IP valuations. Because personally to me, there are so many assets, as I said, somebody cannot replicate. Excel sheet do not give you, actually, in my opinion, when you really do the valuations, you will have to apply cost approach in IP everywhere, just to confirm or do some like sanity check for other methods valuation, whether we are doing correctly or not. Suppose I want to like replace some software or some technology, and last evening only I got some call from Hyderabad late night. He had some banking related technology, some asset, and turnover is around 40 crores, and they are doing some work with some banks, I believe, into some lending activity, something like that, and they are into profit 5-10 crores also. Now that guy has made one preparation of projections, etc., etc., got some market deals also, database, like this company got such a huge valuation at this turnover, etc., etc. Now I want to know my valuation. I said, boss, I will give you the business valuation, but your real valuation, business valuation will be maximum 100 to 100 crore. He said only 200 crore, but I have got this technology. I said, what is the use of this technology? There are already so many members, so many deals, and they are flooded with money. And this technology has life of how much? 2 years, 3 years, 5 years. After that, it will become very routine technology. Like Zoom calls, it was a technology or very attractive option 5 years back. Now it is very common. So many options are available. So again, so cost approach, I just told him, okay, if I have to buy your this IP, what I will do the valuation. I said, fine, boss, I will not pay you 1,000 crore for this valuation. He was expecting me 1,000 crore valuation. I said, I will have to do some calculation. I actually told these logics. What is your cost? He said, I spend like 5 crores over development. Okay, 5 crores. What is your so far say there is no depreciation? Fine. I added some inflation of 50% over 5 crores in 5 years. Then I said, okay, profit margin 50%, 7.5 crore. And what is my opportunity cost? How many years it will take for me to achieve current level of your business? Or even extrapolating next 2 years of business also. He said in next 2 years, I'll be 100 crores. Okay, fine. How many clients you have now? Say, he said 15. How many you will have after 2 years? He said 30. How much money I will have to invest to reach to your level, into marketing and all this development team, people, etc. He said around 50 crores. I said then under this method, I will give maximum 100 crore only. Not even 60 or 70 crore, maximum 100 crore. because I can replicate this everything into 2 years. Then he got, he was like tensed. I said, fine, I'll do the reworking and come back to you. So this is unavoidable method. And this method, in my opinion, is a common sense method. Only thing is that they were just documented and given you in phases. It's a very common, strong common sense. If you want to, you can apply this into your own life also. And there is no need to have a standard on this method. These are the methods, types of assets, and why these are the logic. This is very important slide for everyone's point of view. Which method to be used where? Like cost approach, you can use, there's again overlapping, as I said. If you are not able to identify income or market method, you can go back to the cost method. Like license, permit, certifications, software, workforce, you can use cost approach. Because it's a premise that a prudent third-party purchaser would pay no more than the asset it has a replacement cost. Income-centric methods, income approach like relief from royalty, excess earning with or without method, greenfield and distributor method. There are other methods also like profit split methods and all, but are very rarely used. Like you can use royalty method for brand, technology, know-hows, excess earning, again license. License you can use again cost approach as well as income approach also. This entire income approach is based on the logic of discounted cash flows. But now you cannot just simply apply discounted cash flow here, like a normal share valuation or business valuation. You will have to create scenarios before you actually apply. I will explain how to do that. With or without method. It's a method where you have to create one scenario. You have this asset and you don't have this asset. Then what is the gap in the valuation? Now this asset is basically again the opportunity cost valuation only, like cost approach. It's a combination of income and cost approach. Greenfield is the logic that you have only this asset. Now you have to add other toppings over that to create a full-fledged business valuation. So you have to identify those other assets and create that scenario. And distributor method, very rarely used and typically for customer agreements. I'll give you one example also. I recently did this valuation. Now again if you look at here, mining rights and all, you have no option like water mining, or you have to use the greenfield method only. You can't use DCF, other methods. Like there are typically certain, like suppose if somebody has a coal mines or some iron ore mines valuation, because in Karnataka there are so many mines there, you might get certain valuation assignments. Don't go here and there, simply go to greenfield method. They will give you correct guidelines and you will get a correct valuations. Income approach basically typically use everywhere, honestly speaking, except certain areas like trade licenses, non-competition agreements, etc. Logic is again very simple. Cash is king. Very simple logic. I will not go into detail, and this self-explanatory I'll explain you again. Inputs like relief from right now. Once I start one method, I'll go to the actual live example, so we'll understand the sync. Shilpa, you want to take these questions? We have planned to take these questions. Then I will finish this entire presentation now only.
Actually, this program we initially thought we'll have CPRs, but then now we are not. So in case you want, we can run the poll. Otherwise,
so then I'll go step by step only. So people will be able to sync with the actual practical case.
Okay.
Yeah. Then we'll skip the questions.
Okay.
Okay. Then these are the typical key inputs on the royalty method. Very like normal DCF, revenue forecast with the intangible asset. What is the logic behind this royalty method? I'll tell you first. Logic is that suppose we are valuing, say, some brand. Okay. So you have to create one scenario where you normally client will give you say projections for on a consolidated basis, standalone basis. Now this includes all assets, tangible and intangible assets. Let us say it has only intangible assets, say brand. The logic behind this model is you have to know, like hypothetically, create two scenarios. One scenario where all the other than intangible assets, every normal company is there, and create one another scenario that this brand is owned by a third party. Okay, and now this scenario you will have to identify third party's royalty rate. How, suppose there is one company who is owning that brand, and it is like that company is giving on license to you for use. This is the scenario. Okay, so you have to apply your thoughts again. The question is, what is my royalty rate? I will give you the explain how to calculate that. What is my royalty rate? Number one. Okay, suppose that brand is owned by him, whether he will have to maintain that brand also. Suppose I am giving somebody some property or some office space, somebody to use. So all the maintenance charge normally is paid by me only, taxes paid by me only, or any other building maintenance is incurred by me only normally. Similarly, that brand ownership company will also maintain its brand. So how to calculate maintenance cost? I will give one example. So it will have its own P&L, royalty income, maintenance cost, normal profit. You can also consider working capital adjustments on etc. etc. Also in that normal like logics are again DCF logics, and do the discounting, do terminal valuation, come to the value, add tab if it is applicable, and do the royalty valuation. Very simple. Okay, I will now, what are the key inputs like forecast, life of the intangible asset. Now, what is the life of that particular intangible asset? There are now, like normally in pharmaceuticals, life is more, but in technology, life is very less. Technology life is very less because it is continuously getting changed over here. Suppose Zoom, if you look at the Zoom will always have some upgrades. Teams, it is very different now. What Teams had 2 years back, now it is very different Teams. So these maintenance or upgradations are unavoidable. So you have to identify those costs attributable to that intangible asset to maintain the quality. एक मिनट, थांबा ना एक तासभर माझ्याकडे येऊ नका. दरवाजा लावून घ्या. So you will have to forecast those things also with a proper logic. Now, these royalty rates I will explain, discount rate, etc. Then comparables, if it is available on a notional royalty rate. Now royalty rate, you have an option to normally royalty rates you have database. I'll just share you how it is. I want to example. So these are some of the reports. Like there is one website called Royalty Source website. They have this 2018 report I had in my record. So you will see the licensing royalty rates. You will have to pay for these reports. These are not free reports, like around $150, something like that. Now you will see on an average licensing royalty rates. Now this is not technology licensing. These are all, so they have their own studies. They use lots of databases and create one industry-wise guidance, like pharmaceuticals, etc., automobiles. These are overall licensing rates. You can use it for even transfer pricing, benchmarking of royalty rates also, or for these valuations also. These are very typical websites. Then they will give you these average, median, first quartile, third quartile, maximum, minimum, count, how many samples they have taken. You will see this is very comprehensive. Again, you will see some of the other numbers like, where is this? Yeah, now these are technology licenses. So you can, in this report, like say pharma, Overall license rate is 7.3.
There is nothing coming on the screen except your photo.
Oh, seriously. I'm sharing entire.
I could see the royalty rates PDF. The screen is royalty rate industry summary.
Yeah, it's a correct.
I can also see. I mean, there's no issue.
Actually, I'm getting request, Mr. Anand. We'll be grateful if you could share this particular PDF, please.
Yeah, I will do that definitely. But this is again, Shilpa, 2018 rates.
No problem. At least a guidance.
For your
I was
reference, I will share it. Yes, I will share these numbers. Okay. So this is the overall benchmarking rate they have given. You can use say pharma 7.3, but pharma technology they have given other rates. This is technology licensing. So where is pharma? Pharma is here 4.5 median. We normally don't use average. You can use medians also. Medians are more better. Okay. So you can use these references. Now, how to identify brand out of this? These are mostly technology. If you look at the average, it is 7.3 or energy 5.8, and they have given the same reference here. So these are mostly technology related rates, but there is no direct correlation of brands here. So you can assume like 25-30%. Normally in pharma, again, brands doesn't work. What work is formulations. But in food, brands will work. In consumer goods or other things, brands will work. Okay, so you have to apply that kind of logics also while giving, giving reference to the brands. There are again certain websites, same website, where you can actually go for brand licensing of industry wise. Those royalty reports, they will give you like approximately it will cost you, I think $300-400 for one. So they will give you like 10 report summary, 15 report summary, like that. So that also you can specifically ask. Now I want this industry like food industry or something like that. I can show you one report also. 1 second. Give me one moment. I'll just did not copy that for this. You can see this screen, Excel sheet.
Yes, yes.
Yeah. So this was, I think, in July only I downloaded this report. This was for some tea, coffee related products. So I actually categorize because I had some this assignment of benchmarking of royalty rates for some tea manufacturing company in India. So I actually downloaded this report. I identified some. So they have their own like listing of 500 deals. Then you can read the summary and choose which reports you want. And accordingly, per report you have to keep adding like some $10 or $50 per report, and you can download this. So they will give you this very simple summary. What is this property? Where is this? Or all that. We'll see what kind of this is, mustard, vodka, etc., or some brief details they will give you. Then what is the benchmarking rates? Just a second. Yeah, what is the benchmark? High rate, low rate, upfront fees, agreement date, etc. What is the basis of royalty, upfront fees? See, now you can identify here it is brand, mostly brand, not technology. See, they will pay 40,000 upfront royalty, net sales basis. So you can use those calculations and arrive at some numbers, basic logical numbers. So I think we arrive at some 5 or 6% of on an average. We did that complete calculations. This is the original sheet what they shared with us. But actual, when we studied those agreements, they actually give the link to these agreements also here. You can actually see the agreements also and make that entire tabulation and then arrive at the advisory part. Similarly, you can do it for brand also. And that is the reason brands take valuation, take more cost and time efforts. These efforts you have to invest into reading those agreements, industries, etc., etc. Yeah, so I'll share you this copy, no doubt, and you can use these references also. So, as I said, royalty needs to be somewhere, documented, not your choice. That is the logic behind.
Mr. Anand,
Yes, sir.
this royalty rate for a brand, what you mentioned, this all the industry report.
Yes, sir.
This royalty rate for brands, is it depends upon industry or depends upon a group?
So it
See,
depends
it all
on,
depends.
see, when you have some third, see, now what is your assumption, sir? That's that particular IP is owned by some third party company.
Correct.
You will have to pay at a market rate, arm's length price, correct? So wherever there is a some agreement of licensing within group companies, these are not arm's length pricing agreements. Okay. So what you have to do is you have to actually go to the market and see all these what I just showed you, that calculations. Similarly, you have to identify those rates and do some mathematical calculation to arrive at a logical arm's length pricing of royalty. That is the reason, sir. So these reports are summary of those things. These are ready-made, but these are very limited because these are cheap reports and these are commonly used. But if you want to go really into depth, identify only tea or coffee related brands or something like that, then you have to pay more money to identify those things. Like out of that 300 or 400 reports, I believe with this. Out of, see, so how many samples they have used? They are given somewhere. See the samples, 7,880. In pharma, they have used 3,400 samples. So not every, like it includes cancer, oncology, it includes orthopedic, everything. Na? But if you have some technology patent validation of orthopedic, you can't use this. Are you getting to me, sir? So
Yes,
orthopedic will have different and oncology will have different, everything has different. And if your client is ready to pay you, then you have to purchase that database also.
Thank
you. Now coming back to the slide. Now one more part is discount rate benchmarking. Here you will have to understand one very important part. Sorry. One second. Yeah, you can use this discount rates, how to calculate discount rates. Now discount rates is very subjective actually. You can use equity rates, you can use cost of borrowing, risk-free rates, WACC, normal DCF. There is one concept called VARA. VARA I will explain you. VARA is basically weighted average return on assets. When there is concept, when you are doing some scenario creation, you will identify intangible asset, tangible asset, working capital assets, and you have, and every asset will have different discounting or cost, like WACC. So similarly, WACC, you have to calculate asset wise separate costings, and suppose your working capital will have lesser interest rate, but term loans have more interest rates. In that case, so in that case, you can have do some weighting of that thing and do calculation of VARA. You can use VARA also, and IRR typically is the IRR. Sir, can you just mute? Yeah, now risk associated this topic. 70 number. Cost. Anyway, so basically, you have to do the risk premiums. Normally, intangible assets are more riskier than the normal equity valuations or any other tangible asset, because everything is intangible. Nothing you can touch on your hand. Nothing is that everybody will buy that. So whenever you are doing some valuations of intangible assets, you have to consider the life, number one, cash generation capacity, number two, royalty, and the risk. Like risk of having same Zoom application will have, because it's established now. But if you look at Zoom 5 years before, it will have very high risk. Nobody knew this concept, or only high, like all this video conferencing facility was very high, costly. So nobody knew this. So risk premiums will always have to give more than the equity returns. Again, these are the typical steps. I'll share you, but I will explain you more in the calculations. Like develop the projection scenarios, develop royalty rate. You can use. There is a 2-3 links also I've given. I use royalty source, comparatively cheap, but royalty range will give you very comprehensive report. But this is very expensive again. Depend on the client whether they are able to pay us or not. Again, royalty range will give you ready-made analysis. That is why it is costly. Wherein royalty source will give you summary, then you have to do your own maths. Then maintenance cost, etc. You have to deduct. So these are basically all discounted cash flow logics. I will show you one. Brand. Okay, I'll take this. Now, this is actual live case of one company. So, I actually use their trial balance to understand. So, royalty rates, how we calculate it. I'll just show you. Yeah, so now this is customized royalty rates. Reason was this particular company is based in South India. Now, what happened? They are a regional player. Their group turnover was like, I think 300-400 crore in that particular city only. So it's not a very established pan-national brand. So I was not inclined to do some royalty-based, royalty rates. So I actually calculated what I should pay you. Then I discussed with the management, what do you mean by brand? So especially in real estate, brand is not just a logo or something. It will come with lots of other quality control issues, processes, construction applications, quality of people, etc., etc. So I actually went through their P&L on consolidated basis, identified total cost, what is the percentage of their, all these percentage to their sales cost, etc. And we actually discussed that what is the difference between your staff and normal builder staff, or what is the difference between your processes and any other builder staff processes. So we actually identified certain extra cost which he is incurring to maintain that kind of quality. So we identified and do some assumptions like 50% of his this quality control staff, maintenance staff, 50% we allocated towards the cost of maintaining that kind of brand. Brand does not mean Maruti Suzuki brand is not just a print. It has more than 40-30 years of efforts to create that brand, and efforts comes up with lots of process, post sales quality, maintenance, customer relations, and after that summary is the brand. If you lose, it will lose immediately everything. People will forget that brand in 3 years. Okay, so you have to identify those costs, apportion it to the quality control and maintenance cost, expenses related to quality or brand. So this was total overall cost to the they used to pay, and percentage of cost. So out of this overall P&L, almost 12% they were paying for this entire quality controls, directly or indirectly. So out of percentage of turnover, it was coming at around 4.66%. Now the logic behind this was we added again markup, because when I'm paying third-party royalty, he will do it for profit. So I added markup of 50%, and my final rate, internal rate, I calculated royalty 7%. I also did some sanity check with the other reports. I mean, I just Google, I did not pay for this. So I got some reports like Global Summary or some Walter report, and where they also confirm 7.46% reports also. So 7% was agreed rate of return for royalty. There is one very special case. Normally, this model is not prevalent in India, but in Pune, there is one tower called Trump Tower, Donald Trump Tower. It's actually royalty based. So I started digging into that. So they sold like 42 units for 7 crore each and all. How much Donald got this royalty? So he got some 12 crore royalty, which comes at 4.8%. This was just for my reference. So I thought now this includes lots of, again, same identical like brand, process, etc., technical, everything. So we just calculated fine. Then Donald might have got 25% of entire 12 crore, but other 3 crores are for technical support, or maybe 4, but we don't have exact breakup. It was just actually Indian scenario case. So still client agreed, yes, 7% I would have charged, and he actually had this plan to charge some royalty for some other franchises. That is the logic behind that. So this is how we concluded on the royalty rate. Coming back to the discount rate. Now discount rates, I did not have any other discounting mechanism option to me. So I just went to the equity research, screeners. And that time I just compared some reports and concluded the average operating profit margin. Everybody has a different operating profit margin. So we just said, I think 10 or 11% can be operating profit. This is the minimum profit every brand has to give me. If my industry is working at 11% markup, so this is the minimum basic I have to give. The average was 19%, but median was around 11%. So I said, fine, we'll discount it as 11%. So operating profit margin, because what was the logic? He wanted to lease out his brand for some other companies outside the group. So I said, then somebody will also pay you minimum. His expectation is minimum 11%. More than that is what your value is. Then he also agreed on that. This is how we read is what we excluded, because they have some abnormalities. And we created one balance sheet scenarios, and this is how it came out. This table takes 10 minutes, but entire linking of this thing will be very huge. It took us 3 to 4 days actually. So like we agreed on 6.5% of royalty rates, and we presume that it will go on like every year 3% more and like that. No logic behind this. You can have constant rate also. The assumption was like gross income of the group projected 27,142 crore like that. Royalty rates to be charged. So this is basically multiplication of royalty income. So I'm creating a royalty basis. 4.66 the brand maintenance cost. Okay, again coming back to the basis. So this is maintenance cost. So 4.66 is my maintenance cost and total cost. Gross margin, tax. Now it's a third party company. You have to factor tax also. After tax, I did not factor here working capital or fixed assets or capex here, because I presume it's a very small scale, so nothing much, but you can also factor that also. Discount rates, terminal value, normal present value, add tab multiplier, and this is the value. Now, any other question you can ask me in this method.
How did you get to the brand maintenance cost, Anand?
Yes, sir. Yeah. So this here it is, sir. I told you, this. So we actually calculated how much he is paying on the turnover. So that group was paying at around 4.66.
Yeah. So this is
percentage.
This is in case you're paying externally, but suppose you are doing, suppose it's the spend is there internally. Will there be certain costs which we consider for brand maintenance?
Yes, sir. Suppose this was internal actually. I mean, these are their group level cost only we identified. But you can take some assumption. Normally, brands maintenance will be initially like we take 50% and then we reduce it. 50, 40, and then we make it standard. Normal. This is also one way to do that. Because after a certain period of time, once your business goes on maturity, maintenance doesn't take much time because all processes are set. Initial first 3 years are normally having more maintenance cost. This is the logics you have to take.
Mhm.
Here we actually.
What do you mean by brand? Sorry,
Yes, sir.
I'm sorry. I think Mr. Abraham still has questions.
Carry on, Ganesh. Ganesh, carry on.
Thank you. What do you mean by brand maintenance here? Because the company which is giving a license, there's also that's a brand that they have it, they are giving it away. So it is the person who is a licensee. If we were to have his own brand, is that the brand maintenance cost, or what does it actually reflect?
Take one practical case of McDonald's, sir. McDonald's has all franchises, right?
Correct.
And they are giving us that license to you. So what comes with that brand? And what McDonald's does at the back end? So McDonald's keep creating brand maintenance, advertisements, quality control procedures. They have their own new recipes or new products development team, right? Typically, new designs, all these parts. So these are the things McDonald's at headquarter level keep doing. And these are the maintenance costs. If they don't do, that brand will perish immediately. Because others.
Okay, that's not part. So that's not part of the royalty that you are saying. You are segregating that part.
When I'm giving you royalty for that brand, then you have to maintain that asset as owner. Like if I'm leasing somebody office and there is external things, the owner has to take care of those assets, right? Not internally, but so externally, or there are costs like municipal taxes are there. There are certain society maintenance costs are there. Some breakages are there. You have to take care. Similar logic, sir.
No, I'm sorry. I'm only asking the report that you have shown, the royalty stat report, and all the royalty rates are there. The question specifically is the brand owner who has to keep on maintaining the brand power. Okay.
Correct.
The cost that the brand owner incurs. Okay. I thought that was embedded in the royalty rate. You are saying that's separate.
Yes, yes. No. See, the royalty rate is his income and maintenance cost is his cost to maintain that income. So,
okay.
Oh, are you getting to me? This is P&L from owner's perspective, IP owner's perspective.
Yeah, got it. Owner's perspective. Okay.
Are you getting to me? Not user's
perspective. Yeah. Not
so
user's
here he is
right?
earning, so here he is earning money and here he will have to maintain this.
Correct.
He is earning this gross margin and now you are doing the brand valuation.
And why the discount rate is so high?
So discount rate is a factor, sir. I mean, it's factor. Discount rate is here actually. This is factor. I mean, calculation here. Discount rate is so and so. What is this? 10.77, something like that. And it's a discounted factor, not rate actually, factor.
Okay, that's perfect.
Yeah,
it's a factor.
So Anand, what is this on row 15 tab multiplier 1.24?
Yeah, so now this is what I told you, the tax amortization benefit. So if you want to sell these products, suppose I am the buyer, I will pay 30, then I will save some tax, right? So tax benefit also I take from him. So this is the logic you have to apply. The tab multiplier, it is called as. So this is number. Normally I use this portal. What is this? You will see this tax amortization. Getting this, sir? Calculating a tab, online tab calculator. Suppose in India we have 25, some 17% tax rate, right? Suppose 10 years is my depreciation period allowed, and what is my discount rate? Say 10%. You can do mid-year or you can do, and you can just calculate it. You will give this automatic factor where you can add around 1.18 times extra. I mean 0.18. You can add value to that tax benefit, which buyer will enjoy over a period of time at current prices.
And the tab, how it get benefit already considered the tax gross margin minus tax, no?
Oh, I understand now.
Sir?
Okay. So what you are saying is that since this guy will be buying this this asset at about 3 million or whatever it is, correct? So and he will amortize it in future. He will get a tax shield, and that tax shield is valued something more, and that you are making it to 3.7 million. That's the logic.
Correct, sir. Whatever tax benefits you will enjoy over 10 years, 5 years, depending on the tax rules and depreciation rules, you will have to calculate its present value as on date and add that value.
So now this sheet is prepared from a seller's perspective, but this portion is from the buyer's perspective.
Yes, then the calculation will change to some extent.
No. I'm asking this particular calculation. You've done it from a seller's perspective, correct? This is the income that he may get from the royalty, correct? And this is his actual expenses for maintenance. So a seller of the product or the person who's holding the royalty, it is from his perspective. And the last portion you're saying, should it be sold to another person?
Yes.
That guy will get the okay. So
suppose internally, if you want to do for only for some financial reporting purpose, then present value you can do. If you want to sell, this is the value.
So two values are there from a seller perspective, from a buyer perspective.
Yes.
Okay, got it.
Because for financial reporting, you cannot add tab multiplier.
Okay,
Because
got it.
What do you mean that for financial reporting you can't add it, Anand? Meaning that
because what is the logic behind tab, sir, is when you want to sell, somebody will take the tax benefit and now you are adding the value here. But fair value concept for financial reporting says you are only user, na? So you are already enjoying those tax benefits internally. So in my opinion, I don't need to add tab multiplier for reporting, internal reporting, financial.
okay, so let me just give you an example, Anand, which I hope you will be able to clarify. See, now suppose there is internally generated brand and we have put this brand into a separate company. From the viewpoint of earning the royalties, and we can also claim that this is the value at which we have set it up. Okay, it's a typical structure which is there. Now, for this internally generated brand, we are not claiming depreciation or we are not claiming tax amortization for tax purposes. However, suppose you want to calculate what is the in case there is any impairment of the brand, which is one of the exercises which people come to us for, let's say. If you want to see what is the impairment of the brand, you will add a tax amortization.
No, sir, I will not personally add tax amount for impairment testing.
Okay, why is that, Anand?
So impairment, you are just valuing at present value and you are just calculating the fair value of this IP. Okay, because if impairment testing, you said you are going to park this brand into some other company, right? Not
right.
Okay, then in that case you can add that because it's owned by third party.
Right. So now let's assume that it is parked there and we are not claiming the tax amortization. So the question here is that tax amortization is not claimed every year. Okay. However, still when we are adding on the tab at the end of the period, we are assuming that the brand can be sold and therefore there is a tax amortization benefit which can be claimed by the buyer. Right?
Yes.
Yeah. So then at that point of time, how do we calculate? Do we use this calculator and say that
you can use that calculator, or you can do it on Excel sheet, but Excel sheet will take some time. It's an easy way to do that. So that is why I use personally this. Because for example, in India, you can do media discounting also because we have to pay advance tax quarterly.
Right.
So this is a ready-made calculator. That is why I give you this direct link.
Thank you.
But you can do internally also. There is no harm.
Thanks.
Okay.
Anand,
yeah. Yes, sir.
See, on Abhiram's question, tab part of it. See, when you're two parts in the question. One is whenever you're doing a fair value assessment, you're not looking whether you're selling internally or externally. You're trying to assess the value what at that point of time.
Correct.
So at that point of time, whenever you're trying to sell to a potential buyer, okay, the benefit associated with tax amortization, that benefit buyer gets it. So I need to probably account it in the value. So if standard is saying that you should not add it, I don't know, but I believe that TAB always must come, probably. Number two, this is second question is completely different. The terminal value, how much of terminal value is relevant in the calculations here, considering that you don't know how long that particular brand can sustain from the uniqueness perspective.
Absolutely correct, sir. Terminal value, you have to apply the logic. What is the usefulness of that asset? Lifelong life of that asset. If you see only life of 5 years, after even if you maintain it and there will be new technology coming up, then there is no terminal value. Absolutely correct. Brands, usually there is a terminal value, but technology or formulations may be in pharmaceuticals, but especially softwares, I believe you can take that call, terminal value. it is there or it is not there. You have to study that product and take the call.
Thank you.
Now the next method is with and without method. Now what is the logic here? I will give you one comparative chart of how the valuation will compare going forward. I'll just shut down this. Now it is a method where you as a valuer has to create two scenarios, logical scenarios. What is does is basically calculate one scenario value wherein you will add that consolidated valuation and you will exclude the intangible asset and create without intangible asset valuation. Very simple. Like I have some some technology. So with technology, this is my valuation. If I don't have technology, I might take some 5 years, 3 years period. Okay. And then how much money I will lose, everything will be factored in that entire this projection model. And then what would be my valuation? Very logical method. You can use this method, but you will see the realistic valuation coming in more in the with and without method. People don't use this method, but logically, personally, I prefer this method over royalty method. Royalty method is very easy method. That is why people do quick calculations there. Royalty percentage, alana falana. But quick with and without method will give a realistic opportunity loss, everything factored into that thing. So when you are advising any seller, you can use with and without method. You are advising buyer, you can use both the methods. So you got the logic behind with and without method, I believe. Then key inputs like cash flows with assets, same typical tax amortization benefits, replace asset, etc., etc. All these are the important key inputs. You have to add the capital. Can I just take 2 minutes break? I'll just join you. Give me 2 minutes. You can read this slide.
Yeah, sure, sure. Meanwhile, I request the participants who would have had, already taken up these kind of assignments to throw some light and share their experiences.
Yeah, I was looking at hotel brand valuation, and based on some research, it looked like for similar type of companies that when you look at the valuation of let's say a McDonald's or whatever, typically you would find that about 30% of the overall enterprise value could be attributed to a brand. So if anybody has a viewpoint on this, as to how much of the total valuation of a company will be attributed to the brand, it will be nice to hear.
I think on the brand part of it, when you take say Hyatt, if a developer goes and ties up with Hyatt, the standard agreement that Hyatt charges, which is the management fee, and that includes part of the brand. So the management fee includes the critical management expenses and includes the cost because the brand is coming along. So you have a total charge that is going on to the company, whichever is responsible. So to that extent, you will know. I think it is probably around 10% or something. That's because I think total the charge is not more than 20%. So even if I assume certain costs that are there, if I subtract that, net of that management cost is going to the brand name. So I knew about Hyatt, I know about Radisson, so I can only talk about that.
Right.
Yeah, so this is one simple example. So management has given me these projections, income statement and balance sheet. So very highly profitable pharma company, highly profitable. If you look at the numbers here, they are working at some, how much? EBITDA margin of 70% or something like that. Highly profitable. So I use royalty method also here, and with and without method. So what I did basically one scenario with all assets in one place. So I created another simple scenario. how much money I will lose or I will earn to reach in next 5 or 6 years with the same formulation. So projected revenue with IP was so and so. I believed I don't have that IP, then I will struggle. This is in rupees millions. So what is the percentage of business I can achieve expected revenue without IP is only what 10%, 15, and it will take me at least 5-6 years to reach even 35% of that rate, because very competitive market again. It's not very easy to penetrate. So what will be my revenue without IP? So and so. So this is hypothetical calculations. Cost of material, again, I use the same percentage. Manpower, I use the same percentage given in the normal projections, and created my what would be my cost, profit before tax, normal tax, PAT, working capital, same I use the basis, and fixed asset additions I also use the same basis. So I created this entire DCF model of without IP, DCF without IP. Now with IP, my discount rate was some 10%, but without IP, I added additional risk premium. These are certain adjustments you will have to do in the risk premium, because without IP, my risks are more, right? Are you getting? So I added around 3% extra premiums here and revised discount. So without IP, my discount rates are also high, and
It's a double
my
counting, Anand.
cash earning capacity. Go on, sir.
It's double counting, right?
Like what?
See, the risk associated of not having a brand. I'm just asking your opinion, your views. Either you take the risks associated of not having a brand name or an IP. Either you embed that in the revenue side, or you embed on the discount rate. As part of that risk is concerned.
No.
Any other risk only, then
No, sir, because
okay.
I'm not factoring anything here. I am factoring just a scenario here, financial projection model. But without any established brand, there are certain other risks I will carry apart from my P&L. That may be manpower cost. I will not get good manpower. I will not get better interest rates from banks, right? I will not have good customers with me immediately. Although some of the parts are factored there in my this thing, but usually I will always have some 10 or 15, 20, 30% extra premium for my discounting purposes, because risk is not only what we will factor in the P&L. There are lots of outside P&L risk also we carry.
Also brand maintenance cost.
That will not come here, because now in this scenario,
Marketing expense will be different for a brand and a non-brand.
Yeah. See, brand does not mean only marketing. As I just told you, brand will have lot many other factors with that. Quality controls is unavoidable with brand. If you suppose if McDonald's doesn't maintain the quality of processes or that food, will you recognize McDonald's as a brand?
But is it factored here? Is what my point in this.
So here, what is see in normal P&L is already factored, right, with brand. We are now here without IP, so I have not considered that.
Okay.
Because now I am not maintaining that brand. I am now going on.
Okay. Now I understood. This entire Excel is only without IP.
Without IP, yeah. Okay. And based on this, then I calculated my DCF, whatever it is, and then I calculated my cumulative value. So what is the gap? Enterprise value with IP so and so, enterprise value without IP so and so, and this is my IP valuation. This is what I got. Again, important factors here is terminal value, etc., etc. But now this is a formula-based pharmaceutical company, and I think you can take a perpetual valuation here. This is how you got. Now this is entire in the sense all IPs together. So I given some weights like customer contracts. It included customer contracts. It included brand. It included formulations. So I given them the weights, and I then broke value into 3 parts. Only this logic, because I could not create one scenario without formulation. I could not one scenario with brand. I could not create scenario or customer contract. In fact, customer contracts I cannot create scenarios only. because there is only typical method available for that. So I then segregated this into some logical numbers. If you look at the summary of IP valuation, you will see here, you will see the divergence. So when I use royalty method for formulation, I got only 1,000 crore valuation. But with and without method, I got 8,000 crore valuation, 9,000 almost. Brand 350, and here almost how much? 1,100, 1,000 crore plus. Customer contract distributor method is so and so, and without method is so and so. See the divergent numbers. Now with the existing company, you can apply certain logics here. Common sense logic, in my opinion. Some company with 500 crore sales and EBITDA of 70%, 350 crore. Will you apply formulation of 1,000 crore? I will not. I will give you better valuation, formulation this or this average. I will definitely give this valuation. Brand, not much impact because they are yet creating their own brand. 500 crore is not very big in pharma. It's a very niche product, but it will take some time. So I averaged out again. And customer contract is okay. I mean, their product is so fine, customers will automatically come. So still I can give some of the, because getting any customer contracts in pharmaceutical is not that easy, especially when you are into US or somebody else and supplying to the US companies. You have their own lots many taste and everything has to go through. So there is a substantial value to the customer contracts. You will see the variance, right? So that is the reason I did not go only with the royalty method. Okay, although it is recommended, because with 350 crore of EBITDA, I can't value brand only 350 crore only, or formulation 3 times of that. It will never happen in pharma. It will be very close to these numbers, realistically. So this assignment is still in progress. So if you have any questions, sir, you can ask me on this.
Sir,
So just out of curiosity.
Yes.
Just go ahead. I'll probably do next.
Very sorry, go ahead, please.
Okay. I have one query. When you actually do that revenue stream without IP, but like how do you benchmark against comparable companies?
No.
Then how do you take a thumb rule of 10 or 15 or 20? It's like, how do you justify that?
Yeah, so I had a discussion with management. I said, boss, where you were when you started this business? And you had just only this IP in place. So I actually went to the financials 5 years back. So they were very close to these numbers. So I added some inflation and all. So I realized it will take some time because it's a very competitive market also. So it will take lots of efforts to go, reach even 100 crore business initially first 3 years. Because in pharma, what happens whenever you are new, you will have to fight with the very generalized or generic products first. Then you will have to establish with the things. So it is always after discussion with the management. You can apply thoughts, but always with the discussion with the management.
That's what, when we were trying to discuss, the kind of sector that we were doing was a niche consulting kind of engineering consultancy combined with implementation.
Okay.
So for them, if I ask them anything without their brand, there is no identity without their brand, because the brand has created the niche of revenue or acquired the new contracts for them. So they had grown the brand along with the growth of the company. The brand has taken a substantial presence. Now, when they want to actually value the brand, then we thought, why not we do without method? But to even perceive a time which is without that, they can't perceive it. It's like for them, that is their end all. That brand is the name that has actually, managed it to come to this. But to perceive that without, they are not able to perceive that what is it without the brand.
Then let us take one example of Big Four and normal CFM. Very simple, comparable in your scenario, correct? So
Correct.
Big Four, let us say KPMG or PwC. So whether only brand will work to get them contracts, or they have also other IPs with them. They have substantial IPs with them. One, trained staff, right? Huge network of global network. It's not PwC, it's a network that is creating now PwC. again customer contracts, again processes, quality controls, etc., and technology. These are the 5 main factors there where we have to compete with Big Four. Now, like this, whenever I am doing overall IP valuation, I can create some scenario. Now I am a normal chartered accountant. I don't have trained staff. I don't have technology much with me. I don't have global network. Then where I will be. So if Big Four is a 1,000 crore turnover, I can be maximum 50 lakhs in first year. In second year, I'll reach. My growth rate will be much more than the Big Four, but it will take for me at least 50 years to reach what current level of Big Four is right now.
So it is more of a perception of
Perception.
what it is without.
With some logic. With some logic.
With some logic, but is it like you justify that perception in your report, or you just
No, I don't justify everything in my Excel sheet.
Madam, the perception, second thing is benchmarking. If a normal CS starts practice, as you were saying, the first year practice will be 50 lakhs. So
Yes.
that has to be the industry norms.
Correct.
That's what I said. When you say that normal CA practices and the initial year is so much, that means there is a comparative.
Oh, yeah. Now, what you can also do in same case, then suppose it's an engineering consulting firm, right? So there are many other engineering consulting firms, especially LLPs or private limited companies. What you can do?
Actually only LLPs, so which you don't have access much to the data.
No issue, doesn't matter. What you can actually do, I use probe in that case. So I discuss with them, okay, boss, give me similar companies which are not established brands like yours. Give me 5 names. And I actually dig up their reports. Then I actually consulted their financials, last 5 years growth pattern, etc. And based on their costing, now they are typical examples of without IP, right?
Correct, right? That's true.
You can benchmark them. There where I use probe very extensively. Normally, their competitors are client knows who are their competitors, right? Like Big Four know their other Big Fours, but there are other top 20 firms where they are good, they are very big size in India, but they are not very established like Big Four. So you can use their costing sheet, you can use their growth patterns, and then you can extrapolate here.
So you just generally write English around that in the report, but it is all part of your workings, right? It never
it is always a part of working. If I don't have this thing, then I will, if management is not able to support me with the scenario, then I will use, actually I use their own 5 years financials 5 years back.
Fair enough, sir. Thank you so much.
I beg to differ if it's okay.
Yeah, go ahead, sir.
I think for with and without method will not be appropriate if she is valuing consulting brand name when they don't have. Typically used for contracts. So if you have a large number of contracts that you are there, then without that getting those contracts, it takes certain time. Then probably you should use a with and without method. But probably therefore therefore she's struggling because smaller entities, they typically, the brand and the business go together completely. So you cannot really segregate and therefore use with and without method, probably.
Now that you will have to take the call once you compare values, sir. Because like in this case with EBITDA of 350 crore and 500 crore sales, whether royalty method is appropriate or not.
No, this is correct, sir. What you did is right. Your example is perfect. For what you are doing, it's a running company formulation, undoubtedly. Okay. So what happens is with this formulations and all this, you have established. When I said, I was referring to the consulting experience that Ms. Maithili was talking about it. So I was just giving my observations. I am not an expert. So I just thought I'll give my perspective. Wherever you are using a with and without method, probably you need to have a trend wherein you have developed that, and therefore that has given you extra edge. You are able to generate revenue. And if you didn't have it, what was the past trend? If you don't have it, then it becomes highly speculative. And therefore, you should see whether any other alternative method you could use it that could help you. So with and without method as an option may be less of a preference as compared to other methods.
Correct.
That's the thought. And second part which I was saying
here because it's a very matured company now. That is why I use this method.
You're absolutely right. You are absolutely right. In
If it
your
is
case,
new
it's perfectly
company,
correct.
yeah, if it is new company, then I will never use this because I don't have any history of which method.
This
Correct.
I
So,
agree.
second part.
Where we actually moved away from that with and without because we were not getting comparable or able to justify it because the brand name itself was like a major part of the industry revenue, right? So they can't perceive something, it's very difficult. So what is it alternative that you would suggest? A relief from royalty is something more appropriate?
Prefer,
But you know,
prefer,
doesn't
preferably multiples.
see in consulting, especially in your case, consulting without the key technical peoples, like Big Four don't have key people. They have pool of huge, huge pool of key people. But like somebody like my firm, I am one of the key people. If I'm not there, I'm not sure whether my firm will sustain or not because it's a person driven. You have to identify these key people or key elements where it is must. Like KPMG will run without any CEO or here in that place or not, right? It's a very professionally run firms. But there are some firms where if key people is not there, then they may or they may not sustain. So that call you have to take. I mean, it's very judgmental. Like without key person, how much a CA firm can sustain? Suppose I die tomorrow, whether my firm will sustain after 2 years, I doubt. Even if I have fantastic processes, very good team, I doubt. Are you getting to me? So that call you will have to take. I mean,
in that case, what would be the more appropriate method in order to gauge it? Whether how do you do it?
in that case, you will have to, in my opinion, I am not sure about the background of your case. Royalty method, you always should apply, no doubt.
Suggested the royalty method, but is there anything else that is more likely
If
in
it
that?
is established, what is the turnover size or what is the business? I mean, in what kind of business they are into?
It's more like drilling and engineering associated with drilling implementation, that sort of thing. Like
What
how
is the turnover size?
turnover is probably like 50-60 crores.
It's a very small company comparatively.
Yes.
Then
But the idea was they wanted to identify how much their brand is worth in order
only
to.
brand, only brand. Then, as I said, you have to calculate this total IP value first, and then establish the breakup point here. Identify how much business they are getting because of brand. Identify how much business they are getting because of their processes and quality, other procedures. Then you can make the breakup like this. Because only brand doesn't give you. Only brand will give you contract for 2 years, 3 years without processes. But after that, you will have to, are you getting to me? So, it's a small company. I mean, it will not give you much divergence in royalty method also or this without method also. But this is very fast growing, like year on year, this company is growing at 50%. So that is why I'm getting so much divergence into valuations.
Fair enough, sir. Thank you. Insightful.
Okay. Now I'll move to distributor method. To be very honest, I only work only once on this method. Distributor method is basically you will have to identify different verticals of your business, which is or functions rather, not verticals, and like a profit split method, you will have to give some markup of each function separately. So typically, how many functions are there? Like manufacturing in a manufacturing company, for example, you have like how much you said manufacturing like HR function is there, finance function is there, marketing is there, procurement is there, multiple functions. So identify the key functions and give a weightage to the function based on the relative importance of that thing. And do some arithmetical calculation, which I will explain you now going forward. Excess earning, I did not cover because of the limitation of time, excess earning method or something like that. But excess earning method is something where you have to calculate like CAC charge. What is this? CAC is asset charge. What is it? Contributory asset charge. So basically, I will explain you this entire method. Yes, so they have given me this income statement balance sheet again. Okay, I created like this profit split. I identified their key functions. I given them some weights, 5%, 5% on their profit weightage. What is their, how much would be the revenue? You can see my screen, right?
Yes, yes.
Yeah. So I just identified those important functions since I was using customer contracts. So I identified I can give weightage to the 5% because this was a very technically dominated company and they have very strong foothold into there. So customers are unavoidable. So marketing team was not really doing any exceptional work to acquire those contracts, but it was basically the quality and the product itself. So automatically customers were coming to them, but still there was some weightage to that. So I gave them 5% only weightage. This is again very judgmental. Somebody can ask me why not 10, why not 5, why not 2? Very judgment. So fair enough in my opinion is 5%. So again, I identified top 30 customers of that company. I considered attrition rate, how much they will lose. Now only 5 or 7% question. It is obvious because they are very dominant into their area. So of course, competition is always there, but there will not be much attrition. So I presume it is only so and so. Growth projected they have given us, and they are actually growing at 50-60% year on year for last 3 years. Going forward, they will stabilize, in my opinion. So customers, how it will go, top 30 best customers in this range, revenue projected, so and so, as per their projections, EBITDA margin, again, before tax provision I calculated, PAT I calculated, normal, everything is normal. Now, this is consolidated, right? This is consolidated P&L basically, up to this. Now what I did, I allocated out of these, what is my allocation to the customer contracts? This is what I did here, 5%, right? So I allocated 5% of this entire calculation. So only towards customer contracts my profit is, because of customer contracts or that function of that vertical, I am getting so much of profit. So I identified my contributory assets. Contributory assets is a concept where you have to identify that function and related working capital and related assets required to run that function. So to earn this, I might have required like 10 million, like 1 crore of assets into all these, maybe website maintenance, maybe like any other equipments or some demos, some demo equipments, technological development, etc., etc. So I added some PPE investments here. I also added working capital because this is the sales contract, right? They have normally 1 month of credit period. So I have my working capital assumptions given in sheet. I added entire working capital out of that receivables component into my working capital as a contributory asset for earning this kind of profit. Now there are not much any other asset required here. So I have CAC charge. CAC charge means, suppose I have to put so much of resources here, like 1195 or some, I will have to pay some charge for having that thing. So I am earning this, okay, and I have to pay some charge, CAC charge for those assets. So what is that charge? So we have some discounts rates, some 10.36 here. So I put in 10.36 CAC charge. So if you remember my discount rates like VARA and all that part, so you can do that mathematical calculation. IRR also you can use discount charge of equity returns also, depending on the what kind of industry you are into. So 10.36 was my CAC charge. So this was my cost of CAC. Okay, contributory asset charge it is called as. So this is my profit earning after tax. This is my cost. So only net profit after my CSC charge for my customer relations or contracts is so and so every year. Again, this is a concept. If you remember royalty method, we had maintenance cost, right? So here is maintenance cost, CSC charge. Similar concept. Okay. Then again, the discounting rates, terminal valuation, cumulative NPV, tab multiplier, and value of the customer assets, customer contracts.
Okay, one question, Anand, because now you have done two methods, let us say, for the same asset, and the values are varying widely. So how will you tackle the situation? Will you do some?
Yeah, now this is where usually not any other method is logical. Like customer contracts, you cannot use royalty method.
Right.
Okay, customer contracts you cannot use with or without or excess earning or any other method. Only residual method for customer contracts is this method, where they have given you logic that you have to split your profitability, charge, identify the assets required to earn that profitability, give some charge for that thing, and accordingly you can run.
Right, but you will come across variants. No, suppose you've used two different methods.
Suppose I can use this method and let us say I use these services. You will see the valuation of immediately how much? Around 12,000 crore.
So then how do you, I mean, what is your thinking process as to, will you reconcile values or will you choose one value in preference?
No, I don't keep reconciling values because logics of every methodology is different. Number one, assumptions are typically different. So what I do, I just made one like previous sheet. I usually make one this comparable table of each value and each logic. And I use my own common sense whether which method I have to follow here. Like this.
Okay.
Because not every method is suitable for every company at every time. In one case, I actually applied all the 4 methods. That was the brand, not brand, yeah, brand only, which was into commercial trucks. And it was so huge work, like I keep digging only, continuously digging. And the sales was like 10,000 crores. Eventually that company shut down, but they wanted to sell their brand. So there was a potential buyer and buyer appointed me to do the brand valuation. So again, there was entire, I had a back history. I had a projection from the buyer because now buyer appointed me. Valuation is always from the user's perspective. In this case, user is buyer, right? I can't do from my perspective or somebody's perspective. So in that case, I had to create so many scenarios with all the options, with the discussion with my buyer. Every method I applied. And eventually I understood that there is no logic. Then I just simply averaged out and given them the valuation, which he also agreed.
Okay. Now
there is no thumb rule for any method, sir. Like in this case, I would give brand valuation. There is not much deviation, like 350,000 crore. But in formulation, you will see huge deviation of 10 times.
Okay, so suppose we come back to a different question then. Let's take the formulation. Now, typically it will be patented and there is a life to the patent.
Yes.
So are you building in that life or
yes,
because you're using a terminal value with perpetuity typically?
No, life is unavoidable. Logic behind every IP is life, expected life. Like technology, I assume only 3 or 5 years max. Okay. Otherwise, there is no life. It will expire in 5 years. I don't use terminal value technology. But for formulations, I can use because they have some 14 or some, I don't know, 60 years, some life is there. But again, this was a very particular case where I used the terminal value because they have developed unpatented technology where they were input output ratio of some raw material. Why they are into 70% profitability? Because normally any other manufacturer use say 1 kg of their raw material, they used to extract some product output was like 10%. But these guys have developed some internal technology. I believe it is unpatented. they are extracting 60% output. That is why they are now having huge profit.
Right.
So now that is the only formulation with them. They have not even taken the patent also for that.
Right. So in the case of a brand, for example, no,
Yes.
what will be the life where you'll be considering for it? 100 years, 20 years, 50 years? What's the?
See, normally brand, it depend again what sector it is. Automobile, if it is there, I would say automobile has become very, kind of a dynamic market now with so many new coming people. This even Ather is coming, Ola is coming. So there is a big threat to the Bajaj itself or TVS itself. So these people are going to remain there. So you can take perpetually, in my opinion, because perpetually we are just growing at 2%, 3%, 4% only. You can take, but technology, yes. If like SAP, Oracle, or you remember some brand called BAN few years back in ARP.
Right.
Now where is BAN? There is no BAN. Correct na? So technology has some life. You can take 10 years, 5 years, 15 years max, depending on their existing dominance.
Okay, got it. Thank you.
Yes. So I'm open for any other questions. There are many other methods, but I have not covered that here because of limitation of time. But I'm open for questions also.
So, Anand, one question: are these methods really applicable when we are doing statutory valuation for income tax purposes, or is it only from a buyer-seller perspective that we use these brand valuations, or is it okay to use it for statutory, for Companies Act and other things, or we make a distinction?
Income tax has not given us any specific direction how you have to value. They say they said if you are qualified to do the valuation, you can appoint anyone. If I'm not wrong. Companies Act says registered valuers, number 1, number 2, IVS or any other standard mentioned by your RVO, correct? So for me, IVS is the Bible. So I use IVS, and if I follow whatever they have given to me, not my discretion.
And if IVS allows these methods, then we kind of go ahead with
No,
that.
they have only mentioned these methods, sir.
Okay. Okay.
Yeah, they have income approach. See, technology. See, excess earning, relief royalty, profit split, greenfield, all that part.
Okay.
Anand,
Got it.
Yes, sir.
while doing this normal business valuation for acquisitions or what is for normal share premium, and there is a two elements. One is a company business growth. Second thing is a brand. Can you do the company business valuation based on the projections, and can you attach the brand value also following around the valuation in the same model what we discussed, so that value can be optimized?
You can do that, sir. There is no issue. But when you are doing business valuation, you will have to create two scenarios. One, business valuation without IP first. And then you can add IP valuation separately.
No, that's what when I say, assume that there is a company, 30-year-old company,
Yes.
they got a growth of 15% CAGR.
Correct.
You have done the business valuation. At that point of time, again, they say that over and above, they say, I have my brand. So at that time, is it appropriate to?
Oh, this is not appropriate because, in my opinion, whatever you have created with this 30 years of experience, there's all factors put together are already incorporated in the business valuation.
Okay, it means that when you have business projections already is inbuilt on the brand value.
Inbuilt. It's a package of all assets together to run that business. Because if you take out that business value separately, then your projection will change for business. Are you clear, sir?
I got it. When you do the normal business projection, CAGR 15%, that is inbuilt of a brand valuation.
Correct, sir. Yeah. So any other questions?
Actually, many of the fresh professionals would have the challenge of, how much to charge, unlike a normal business valuation where the across the fees. Like if you can just guide the fresh professionals as to, because I don't want the market, to see this exercise as a very reasonable, as a very cheap exercise, as how business valuation has become. So if you can guide on that, at least people will be more, thoughtful before quoting.
See, I'll tell you, in my opinion, what we charge is basically we do on kind of a estimated man-day basis, man-hours basis, basically. So whatever time I'm spending, including client discussions, including understanding with my staff, etc., and my staff has some hourly rate calculations. So we estimate that kind of time estimate totality, and then we quote the client. Typically, brand valuation will be minimum 1 lakh rupees. Minimum, I'm talking. It is because when you have to buy these royalty rates or some other resources from internet, you have to pay that thing. So those things also you will have to factor. But when you have multiple assets to be valued, then obviously time will be much more. So obviously cost will again rise 2 lakhs, 3 lakhs, 5 lakhs, up to sometimes even 5 lakhs, because my certain technological valuations, I don't have any experience into that technology. Then I actually hire somebody from Bangalore or some Hyderabad where they are technical expert guys, and they guide me. Normally I don't require to hire them because I have so many startup clients. Somebody is into that segment, so I just take their 1 or 2 hours for discussion. But you can factor that cost also, depending on the cost and time required. Number one, there is no need to discount your efforts, because unless you ask for value, nobody will give you value. And tell them it has value even discussed with you. You are not free. That is the thumb rule of this industry. If you say I am available at your call or disposal, then you have no value. But if you say this is costly, if you also have budget, then only we'll discuss it ahead, then they will give that value. So you have to ask for value first.
Considering a relatively smaller level of operations of a company, do you think minimum timelines will be 2 weeks?
No. I think with this, 4 or 5 days are more than enough.
Okay.
More than enough for single IP, and additional IP 1 or 2 days, because basic projection model or working remains same. Only you have to extrapolate certain scenarios. 3-4 days, maximum 1 week is enough for one assignment.
I think this is the right time that the participant asks the questions, otherwise we can, our doubts will be left uncleared.
Shilpa, you were mentioning that there was a poll that was organized. Sorry. Shilpa, there was a poll that was there. So for the benefit of members, maybe you can still run the poll with or without the CEP.
Yeah, actually, that's what it depends. If people want to ask questions, they can, and parallelly I will run. That's a good point. Thanks. Can all of you see the poll question now?
Yes.
Yeah. While this poll is being answered, people can raise points. And once everyone has attempted the poll, Mr. Anand will throw light on the right option. This is the time I feel very bad. I know the answers and I cannot attempt the poll because I'm the host.
So we don't know the answer, Shilpa. You can ping us the answer. So just out of Mr. Anand, I'm just sharing experience. Actually, it takes much longer for me in intangible assets. So maybe I am doing something wrong. So actually, it takes for me nearly.
We can discuss these questions. I'll tell you. Marketing related means undoubtedly trademark is there. Why you have to identify the incorrect match, right? Let us eliminate what is correct first. So marketing, I don't have any issue with the trademark, correct? Now we'll go technology. Whether patented or unpatented doesn't matter. Technology is the technology, right? Now, third is contract related. So any kind of contract has the rights. Now, what is this rights from non-contractual copyright protection? It has a value. So it is also correct match. Now, customer related, customer list is IP, but it is not to be valued here. You can go with the any other method. What is customer related normally is the customer contracts, not list. That is the confusion only. I made. The correct answer is 2 actually.
We had to find the incorrect match. Actually, that was the correct match.
Correct match. You can take second. Next question. Now you have to identify the correct one.
Oh, actually, if the cursor is taken to the first option, you can see the entire option. You just have to take the cursor wherever it's incomplete, no, or you can maximize the window also, in case you are not able to see the full option.
You have to identify the correct one. Huh?
Friends, meanwhile, you can, whoever is interested to have breakout rooms, please put it in chat. If only we have requisite numbers, then we can have a breakout room discussion. It's been a long time. Few of us could be interested to talk with our fellow friends. I'm ending the poll. Yeah, Mr. Anand.
Only replacement cost.
The second option is the right, is it?
Correct. See, simple now, which cannot be used.
I'm about to end the poll.
Customer contracts. We just had discussion. It's only method. Distributed fund.
Should I run this poll? Actually, this is same like last one, right? Yeah. Now I'll end this poll because it's quite easier.
Identify incorrect. Huh?
Yeah.
3. Correct. Third is correct.
But considering the new amendment, this tab application has to be really examined.
To be very honest, I have not read this new in detail.
Yeah. Thanks to Kusum for updating us.
Yeah.
But this tab amendment is going to affect, no? Earlier, say for example, last year, one contract, the buyer would have paid more considering that he is going to enjoy tab benefit, but now he may or may not get that.
Yes. So if you have to correlate tab with the tax rules, if there is no tax benefit, there is no tab.
Correct. But last year I would have already paid premium, assuming I would have enjoyed the tab.
Correct. So
but
there is
now because of this
change in the
amendment, I
rules.
have lost.
Then you paid some premium for that.
Yeah. So whenever the other person is demanding tab, we have to say it depends.
Correct.
So there is some discounting we have to give for that. Of course, now to nothing is there.
So CAC is not being used for which method?
This is the last poll question.
Yeah. CAC is contributory asset charge.
Actually,
Can someone throw that light again, Shilpa, regarding that amendment you were referring to on tab?
Actually, Kusum updated all of us saying that presently, actually Kusum can correct me, there is a new amendment with the, starting from the current financial year, that any acquired goodwill, earlier, we could get income tax benefit on amortization, but from the current financial year, that the whole concept of tab is that you are going to get benefit of amortization on the acquired goodwill, and you can save tax on that. That is being removed. So the whole concept
This is
of
not
tab,
a goodwill acquisition, right?
Yeah.
This is an asset. This is what, see, goodwill is essentially when you cannot associate a particular value at specific asset. Here, when you're buying a particular asset is there, the buyer is actually valuing that particular asset at a particular value. So he's not purchasing any goodwill there. So tab is very much applicable then, right?
Actually, I'm not an income tax expert. So I feel, next time whenever any person is calculating tab, that the recent amendment has to be.
Yeah, no, Shilpa, what Mr. Ganesh is mentioning makes sense. See, goodwill is something that happens whenever there is a business transfer that happens. Okay, there will be an undertaking that is sold as a going concern. So what eventually happens is there is no value that is assigned to the assets and liabilities that is taken over. Correct. And when in the books of the purchaser, when he actually has to record the details of the assets, he will do his own set of valuation. Let us say a business has been purchased for say 15 crores, but the book value of the assets is say 5 crore, and let us say the liabilities is say 2 crores. So what is the net value of the assets that has been purchased? It is actually only 3 crores, but what has been paid is 15. Correct. So in effect, the excess amount that has been paid is 12 crores. That is called as goodwill, and depreciation on such acquired goodwill was not, was previously available, and now it is no longer available. But in this case, we are talking about brand valuation or, intangible asset valuation and not goodwill valuation, right?
The issue we actually had, or some of us opined, was that if the asset can be identifiable and for income tax purpose can be qualified as a intangible. So when you say that, for example, in most of the software companies, what they buy is like a customer list or a customer contracts and relationships, but you don't capitalize it as part of the book. So in effect, what happens is it comes under goodwill. You don't depreciate it as a block either. So that's where the challenge and whether we have to take the tab or not comes into play. If it is a very identifiable and it is part of the books, I don't see much of a issue identifying it and valuing it. If it is otherwise, then whether you capitalize it in the books is a critical question you have to consider before you consider the tab.
Yeah, we can really, do an in-depth study before next time we take up this particular tab calculation. Just moving back, the CAC, I don't know why none of the participants attempted the poll. I didn't get any answers. So maybe
We were
Anand
not
will-
able to, we submitted, but it did not accept the answers.
Is it? That's why none of, not even one reply I got.
It
gave an error,
It is not giving option. The answer is relief from royalty actually, because relief from royalty will have maintenance cost as charge. Every other method has a CAC charge.
Okay. I think, any final questions to the speaker and Mr. Anand, anything you would like to share with us? We have come almost end of the session now.
Anand, any good reading materials on these topics? IVS is there certainly, but is there any recommended?
No, there is no material, sir. I mean, there are available so many material on the internet, but your discretion. Personally, I get confused with so much material. I apply my own thoughts.
It's so very discretionary, correct? We're applying logic based on discussion.
Yeah, I mean, you have to apply, the only word is common sense. Strong common sense. Nothing else.
Right.
You will get confused with so much material reading.
Okay.
Actually, friends, I will request Maithili to extend a formal vote of thanks to today's speaker. And can you separately, can you put it on chat whether a detailed workshop on intangibles would you want, or you want something on the simulation, Monte Carlo simulation? The speaker, has both, he's expert in both. So we are trying to do a detailed workshop on this particular two topics. So you can just chat me either on WhatsApp or here and let me know so that accordingly I can plan in Jan or Feb.
Can you repeat the topic? Which one you said?
Monte Carlo simulation and same intangibles, but not something like 2 hours. It will be a detailed workshop. I request Maithili to extend. Is she there?
Yeah. Thank you so much, Mr. Anand. It was a very, very insightful. I think it's also thanks to the entire team of BVA. It makes waking up on Saturday especially more meaningful when we have a very nice and insightful discussion. It's a lot of contribution, lot of experience of his has added to how we can actually apply it in our own work sphere. Really, thank you, sir, for a wonderful session. We really thoroughly enjoyed it.
Thank you. My pleasure.
Actually, Mr. Anand's session was very much awaited. I always wanted to have a session from him, but it's just that, we couldn't accommodate the
He is my student, actually.
So your turn, and especially the last part you said was so correct that we read so much, we get so confused. Sometimes it is just more the common sense approach that actually helps us at the final bit, rather than trying to apply a certain method specifically.
Every company, you compare Tata Motors with, say, Maruti Suzuki, you cannot compare same methodologies. Everyone has his own different, internal issues, functions, everything. You have to apply your own thought. Read their annual reports. Then you will understand that company.
I think somewhere this pressure of justifying our work to somebody.
Sorry, sir, your voice is not clear.
Yeah, sorry. I'm saying that somewhere
No, sir, no voice.
He was talking about justifying the, analogy what we take or the workings what we do. How can we do it?
Normally, sir, I don't put a lot of justification in my report. I just give very brief summary because it is open for unnecessary debating. If somebody has any doubts, they can approach me, then I am liable to explanation. I personally don't put so many commentaries I give very summarized, concise, but I give some bullets, but very minimal.
Okay, friends, thanks a lot for attending this session. Bye for now. Happy weekend. Thanks, Mr. Anand.
Thank you so much.
Thank you all. Thank you so much.
Right. Wow.